Before we jump into this week's market update, let me give you an update on our backpack campaign that we're doing for back to school. Last year we did 30 backpacks at a cost of $250, or we spent $7,500. You can see all the backpacks in the back of the car being delivered. These are going to kids from families, mostly single moms, that otherwise couldn't afford it. This year we want to up it to 40, and we're going to increase how much we spend to 300 because we have the very real possibility of putting some Galaxy tablets in these backpacks. So we can't stick with the normal budget. We're going to have to increase it. Looking to spend $12,000, which is an increase of $4,500. And I said that for the next 4 weeks, starting last week, that every single time somebody clicks like, I'll add another $1. Every time somebody subscribes while they're watching that video, I'll add another $1. And all revenue from the video will add as well. We want to hit a minimum of 40 at 300. Well, last week, between the likes alone were over 1,100. That's fantastic. The likes, the subscribers, and the revenue, it added $1,494, which is almost 5 more backpacks. So we're getting there. Again, it's a minimum of 40 that we want to do. There are 3 more updates: July 24th, July 31st, and August 7th. 3 more of these weekly videos. And again, all likes, I add $1. All subscribers that subscribe while they're watching the market update, I add $1. And all revenue go to this as well. Now this will continue to generate likes, it will continue to generate revenue, it will continue to generate subscribers. It's not like it's done. So all of these will tally up to August 14th at 12 noon, and whatever the total is will get added to our total, and we'll see how high we can push this. Okay, let's jump right in now. Okay, let's start with our rates. We last week, our money market rates, some of them hit new year-to-date highs last week, all the way up to the 6 month. The 1 year actually decreased. So 6 months and under, all those rates increased, and then the rest decreased. All capital market rates decreased as well, which kept the yield curve inverted. We're still sitting on the 2s and 10s at negative 21 basis points, just a small change week over week. That is now 17 days up to Friday. And since nothing happens on Saturday and Sunday, you could say that's basically 19 days that it's been inverted now. This is, it's rather interesting, this change in rates and the change in the curve. The capital market rates are not just pricing in a recession, or not just reflecting a potential recession, but reflecting a reversal by the Fed, that the Fed is going to end its rate hiking cycle soon and then begin to reverse. In fact, I have read one posting that suggests the 75 basis points we're going to get this week, which is pretty much guaranteed, is going to be the last hike. And that will be it, because the economy is softening way too fast. I disagree with that. I don't think that's it, not by a long shot. The Fed is not keeping an eye on the economy at all. The Fed is keeping an eye on inflation, period. There's nothing else in the Fed's view. Inflation, period. So this idea that, they got one eye on inflation and one eye on the economy, and they're going to come in with the Fed put and protect the economy, protect the markets. No, they're not. No, they're not. So I sort of disagree with that. Look at this, the 3 month to the 10 year, 28 basis points now. It's dropped another 28, so it's only at 28. 155 to 28. That is the fastest contraction in that slope, the fastest flattening in that slope since the Great Recession. And we're going to look at some other data a little later on, looking at economic activity compared to the levels they were in the Great Recession. So the statement that the economy is showing signs of weakening is a true statement, but that the Fed will pivot because of that, we have to think that inflation will come down as well. Well, I've got some more granular detail on inflation that we'll look at. If we look at the OAS, this is just credit spreads. This is surprising over here. Even this one has contracted 5.6% from 11.95 to 11.28% on the spread, dropped 67 basis points. Double B, which is the higher end of high yield, has dropped almost 12%, 3.72 down to 3.28. And if we look at high yield just in general, investment grade versus high yield spreads have contracted almost 10%. Investment grade spreads have contracted 5%. So these are saying the economy is great and there's no need to be worried about it. So credit spreads were way too wide. Let's bring those credit spreads in. Whereas this is saying the economy is weak. The Fed is going to pay attention to the economy and they're going to stop this tightening cycle soon, and they're going to pivot to a more or pivot to lower rates going forward. They're telling two different stories here. If we look at the balance sheet, I've got July 6th, July 13th, and July 20th. And this is week over week. For the week ending July 6th, the balance sheet dropped 20.7 billion, but then increased 1 million to July 13th. There's no maturities, but then you did have some maturities. When you get to July 20th, the balance sheet increased 5.8 billion, going the wrong way. So I looked into it a little bit more. U.S. Treasuries dropped by 1.5 billion. Okay. TIPS dropped by 9.6 billion. Okay. Residential mortgage-backed securities increased 16.9 billion. And commercial mortgage-backed securities dropped a measly 20 million. But they're low to begin with anyway, so it's not a big deal. But this is a curiosity. They're listed at their face value, which is just the outstanding principal that's left. So it's not mark-to-market gains. It's not as if, well, you had a drop in rates, and when you have these kind of drop in rates, you have an increase in the value of the outstanding security. So these might just reflect a mark-to-market gain. They're not listed on the balance sheet that way. They're listed at their face value. So I don't know what's going on there. Maybe somebody with more experience with the Fed, with the SOMA, and with mortgage-backed securities can, in the comments section, enlighten me, because I find that to be curious, that it seems to be going in the wrong direction. You got a Fed meeting July 27th. So you can have a 100 basis point move or 75 basis point move. I put a 75% probability on 75 and only a 25% probability on 100. If we want to know what the market is pricing in, we can look at the federal funds rate for August. It's sitting at 2.35, and if you want to calculate the probability, take the 2.35 minus the middle end of the range that currently exists. And right now we're at 1.5 to 1.75, so the mid part of the range is 1.625. This is where Fed funds futures are. This is the mid part of the range, and divided by the move you think you're going to get, which is 75 basis points, you get 97%. The denominator actually is the mid part of the new range, would be 2.5 minus 2.25, minus the existing part of the range, 1.75 minus 1.5. But that difference is just the range you think you're going to get. So that's why I put that on the bottom. 97%. You want to get that number. You can calculate for a number of different ranges, 50 basis points, 25, 100. And you want to get the number as close to 100 but less than 100 as possible. That is the most likely move possible. So if I had divided this by 50 basis points, it would have been over 100%, which is a certainty. As soon as you get over 100%, that's a certainty. You move on to the next one. If I divided this by 100, it would be less than 97%, meaning that the market is placing all of its weight on the 75 basis points, and everything beyond that being a lower probability is less likely. If you use the 100, you get around 73, 74%. So I went with that, saying, okay, well, 25% for 100 basis points move, 75 on the 75. This, based on the economic data and the PMIs, is probably right. Based on inflation and the flexible versus sticky components, I I still think there is a possibility of 100. The idea of front-end loading this, of getting to what is a neutral range faster rather than slower, seems to be sort of gaining traction with Fed officials, if you listen to the way they speak and what they say, and again with other commentators who have an opinion on what the Fed is doing, people of significance. It's still there. I'm not willing to take that off the table. It's still there. December is pricing in 3.31. We're going to see what terminal rate that is associated with, the highest probability terminal rate that's associated with. All right, let's look at our real yields. All of them down. The lower real yields go, the more supportive it is of equity prices, because the discount rate is dropping, or the real discount rate is dropping if we want to eliminate the effect of inflation. Still, the year-to-date highs have not been breached by any of them. Note that this is from the 5-year forward. They're all capital market rates. Break-even rates from the 5-year forward, and this is the 5-year forward. All of them have dropped. I say it's roughly unchanged because these are small little basis point moves. It's not like it's a 15. These are fairly large basis points moves. These are small. So I'm puzzled. You have curve inversion. You have a flattening of the 3-month to 10-year very rapidly. You have all real yields are dropping. Break-even rates are dropping. Both the real yields and break-evens are from the 5-year forward. All of these are recession signals. However, the OAS on both investment grade and high yield, even CCC, are dropping. CCC are the most dangerous ones you can buy. The default rates tend to be very high in there. It's like, hey, listen, if you have extra money and you don't mind losing some of it, you can go ahead and buy some CCC. And this is reflecting a strong economy, strong labor market, and earnings. Earnings have been good so far. This last week, we're going to have a look at earnings. Yeah, some companies missed, but if we look at how many have beat what the estimate was, now mind you, it is lowered expectations, but they still beat the estimates. Strong earnings, strong economy. They usually are very, our spreads are pro-cyclical with that the stronger the economy, I should say counter-cyclical, sorry, the stronger the economy is, the stronger earnings are, the smaller the spread. Who's right? I don't know. Let's look at this interesting work that was done. I'll show you more of it here. This is a disaggregated CPI Phillips curve. Really interesting stuff. On the bottom you have the unemployment gap, and over here you have the 12-month % change in inflation. And we know the Phillips curve, if you look at inflation versus employment, looks like this. At low levels of unemployment, you have very high levels of inflation, and at high levels of unemployment, you have low levels of inflation. And since the Fed has a dual mandate, first one being price stability, the second one being full employment, this is a kind of a neat way to pull apart the CPI. What is this employment gap? This is unemployment minus the natural rate of unemployment. So if unemployment, we're sitting at 3.6%, and they feel the natural rate of unemployment is, let's say, 4.5%, then you'd have a negative gap. And so we're down here somewhere, wherever it happens to be. And you have green dots, tan dots, and black circles. The green squares here relate to what's called the flexible components of CPI. If you just take those, these are the ones in which you get price changes very quickly. Call that flexible CPI. Then you have the sticky components called sticky CPI, and then you have CPI as a whole. As unemployment increases, look what comes down the fastest, the flexible CPI. In fact, you can bring this over here and see it almost, you're in the deflation zone over here. But look at sticky CPI. It doesn't even change. Just completely flat. It does not matter what the level of unemployment is, hence why it's called sticky. It's not going to be very responsive. CPI comes down a little bit. The flexible part really comes down. Powell, when he described the labor market, these are his words: extremely tight, unsustainably hot. What are the two mandates of the Fed? Price stability, full employment. Do you think he's got full employment with these words? Yes. Has he got price stability? No. What do you think he's keeping his eye on? What do you think the committee is looking at? They're looking at this. They're not concerned about this. We're going to see that we have some economic data that is rolling over. Some is showing contraction, some showing a slowdown, but not employment. The Fed's mandate is not a full production capacity. The Fed's mandate is not positive equity market returns. It is price stability and full employment. And right now they're losing badly on price stability. There is nothing else on their radar. So this idea that, well, the economy is weakening, they're going to pivot very shortly. No, they're not. They're not going to pay attention to the economy. They're not going to do it. They're going to look at price stability, and that's it. And this is a problem because a recession will only make this worse. So let's tear apart this sticky versus flexible CPI a little bit more. And on the next screen, we'll look at the categories in flexible CPI, and we'll look at the weighting of CPI, the flexible versus the sticky. Here, this is the blue line here is sticky price consumer, or sticky CPI less food and energy. So it's a core version. And this is flexible price CPI less food and energy. So it's a core version as well. So we're comparing on the same basis. And we have to cut it off at 1983. Because at 1983 there was a change in the OER calculation. Now I want you to look at something really interesting. Look at the volatility of the blue line up to 1983. Now look at it after. Look at how that volatility has basically disappeared after 1983 by changing the calculation of how you calculate owner's equivalent rent. So the inflation numbers that you saw over here, were they overstated or were they truly stated? The numbers you're seeing over here, if you disagree with the way OER is calculated, are these understated? In other words, would CPI be higher if we counted them in a way that reflected the expenses people actually incurred? Hard to pull that apart because housing, again, is an investment asset. It is not an expense. Much like stocks are investment assets. We do not include the price change in stocks in CPI. That would be ridiculous. We do not include the price change of houses in CPI. That would be ridiculous. However, stocks, you do not have to buy stocks. Housing, everybody has to at some point incur this cost of housing. It's a forced investment, so to say. So, there is a debate on, should it change to reflect the expense people actually incur as opposed to the opportunity cost of what they could rent their house for if they did rent their house. Either way, I find it interesting that you have this massive drop in volatility. But the other thing that you have is it's not as responsive. Look how responsive the sticky component was before. It was not so sticky. The notion of stickiness, it followed the flexible component fairly closely. In fact, you could say it was probably a little bit more variable than the flexible component. It only became real sticky. The notion of stickiness only showed up, I think, after 1983. Anyways, let's look at this. This is monthly variance of flexible and sticky CPI aggregates. Here's flexible CPI. Here is core flexible, which will focus on that. And these are variances. Variances 1983 forward. So it disaggregates the whole series. And if you look at core sticky, so this is core flexible CPI. This is core sticky CPI. Look at the difference in the variance. 1.9 versus 15.79. So when this drops, it really drops. When it goes up, it really goes up. When this drops, not so much. When it goes up, not so much. And you can see that with the blue line up here. If you exclude shelter, this is core sticky CPI excluding shelter. It is a little bit more volatile, 2.58 instead of 1.9. But that 2.58 compared to the 15.79. So what we can say when we look at these is whatever definition they're using of core flexible CPI, whatever is included in here versus whatever's included in here has clearly been able to distinguish between the two. So we can feel comfortable in looking at the data series saying, I'm not too concerned on what you classified into each one. Your numbers here really show that you have distinguished between two of them. This down here is this chart over here, this whole chart. So this starts from January of 2010. This starts from December of 1967. Look how high this got. The flexible component. This is 20% up here. Got to 20. And it's really come down. And this is what we've seen with energy prices that have dropped over the last little while. Some food prices, commodity prices have really come down. 8.4%. Still 8.4%, but the sticky component is at 5.425%. Now, if we're thinking that inflation can come down because the flexible component is going to do most of the heavy lifting, it would be nice if the weighting were like 60% on the flexible and only 40% on the sticky. Then yeah, that might happen. Even if it were 50-50, even if it were 40-60. But we're going to see that the flexible component doesn't even get to 40%. Okay. Here is how they defined what is a flexible price item versus what is a sticky price item. It is the frequency of price adjustment, and it is in months. The more frequent you have a price adjustment, the more flexible it is. The longer the time between price adjustments, the more sticky it is. So when we look at something like this, motor vehicle fees, personal care services, miscellaneous personal services, these is almost every 2 years you have a price change. This is all of this here, this whole category in here is shelter. 11 months, basically almost once a year, which makes sense because rents turn over once a year. So 11 months, and this is 30.4% of the CPI. Here we have the total flexible price items. The weighting is 30%, but if you take out fuel and food, you get to 14%. Only 14% of the core is flexible. And here, if you do the same thing, you just look at the core. Only 60. Well, you go from 70.1 to 63. 63.6% is sticky. So core represents 77.6, which is about right after you take out food and energy. 77.6%. And of that 77.6, 14% is flexible. The rest is very sticky. And we know that even by taking out OER, you get down to 45%, 14 versus 45. We've already shown that there is a 16-month lag between housing price index rolling over and OER rolling over. 16-month lag, that even though housing rolls over, OER still continues to increase. But if you find the correlation at 16-month lags, the correlation is 0.75. So we expect that to continue for a while. We'll look at the real estate market next, and we'll look at housing activity is turning down. But the median housing prices hit a fresh record high again for, I think it's like the 124th month in a row. Frequency of adjustment here 5.3 months. Some of these are half a year, but this stops at 4 months. Let's look at the market expectation, what the market is expecting for Fed rate hikes. This is July 27th, September 21st, November 2nd, December 14th. 75 basis points is pretty much in the cards. The expectation is there'll be 50 in September, followed by 225s. For another 175 basis points on top of the 175 we have now. So that'll put us in a range of 325 to 350. The December Fed funds futures sitting at 96.69 is implying a 3.31 federal funds rate. Minus the mid part of the range right now, this is 1.75 minus 1.50 divided by 2, the mid part of the range. Divided by the number of basis points the market is thinking, there's 96.3%. That is basically where the market is right now. It's the closest to 100 without going over 100. If you put 200 in here, 225, you'll actually get a lower percentage. So 96.3, this is the most likely expectation right now that the market is pricing in. So if you are doing sort of a top-down analysis of where you think prices can go, you would start with this. Is that 175 too low or too high? To determine it, you really have to understand, well, what is the Fed paying attention to? We've seen the language in the minutes before. They are solely and 100% focused on the inflation rate. They have mentioned on many occasions that they are willing to live with a higher unemployment rate if it means getting inflation down. They are extremely worried about the door closing on them and them having to do something more expensive down the line to reduce inflation. Do you really think that they're going to pivot in September and say, okay, considering how much of inflation is sticky? We've already seen the volatility of the sticky component is very low, which means it does not come down very much, hence the term sticky. The flexible part comes down, but it doesn't have enough weight to really move the dial. And OER, it's got a weight of 30%. We know that housing price index has not peaked. It has not peaked. So rents and OER have not peaked. Once they peak, 16 months later, these guys peak. What do you think the Fed is? Do you think all this is going to disappear by September 21st? And then when they get to know that they can then drop from 75 to 50 and say, I think we're good, and then give guidance for 25. When they get to November, we're already July. So you're talking 3 months, 3.5 months that this sticky component is going to disappear. And they're going to take their eye off inflation, say, okay, well, it's down at 6%, but unemployment's at 4.2 now. Let's go save the economy. No way, no way. In fact, I don't think that they're going to do very much until they see unemployment over 6%, which means quite a ways to go because the job market, Powell is right, is tight, and it is the wage gains are pretty high. You still have over 4.3 million quits per month. Out of 5.9 million separations, 4.3 million are quits. Well, look, there's an economic reality to life. You don't just quit your job, go home and say, that's it, I'm on strike, I'm not working. Well, you got bills to pay. You quit your job because you got a better job. We saw a lot of that data last week from the Atlanta Fed, the wage growth tracker. So you have to destroy a lot before you're going to move the economy to a point where the Fed says we should be paying attention to this. So I don't think so. This is my expectation over here. 75, 75. I think they'll front end load. In fact, I still think there's 100 in here, but 75, if they don't do 100, you're in for 75 the next time. 75, 75, 50, and 50. This is based on where we are now. I think that you'll probably get something like this. You're not going to get a stop. They're not going to stop raising rates, but I think they could moderate the rate hikes if the economy looks like it's weakening too much. If the PMIs keep coming in under 50, if housing continues, especially if housing prices really start to show a drop. I don't think so, but I think you could see this. Maybe in, after next week, we get GDP next week, we get PCE next week, and a whole bunch of earnings. I might change this to 75, 75, 75, 75. Or I might drop this 50 down to 25. Who knows? But I'm thinking 250, not 175. I'm thinking the market has not priced in at least another 75 basis points of hiking. By the way, the Fed funds futures rate peaks in January 23 at 3.355%. It peaks there. Saying that, the 3.25 to the 3.5, that after they do this one in December, they'll be on hold. And that sometime in 2023, they'll have to start cutting rates because of the recession. Not if inflation doesn't come down. They're solely focused on that. If you use 250, you get to a 67.4% probability, or another way to look at that is my expectation is only 67% priced in. That there's still a ways to go from like 175 to 250. I don't think that's priced in, and I think that realization will start to unfold slowly over time. But I think as we start getting closer to September, you'll see this 50 move up to 75. Other central banks, keep in mind that it's not just the Fed that's raising rates. Central banks are raising rates everywhere. So we have to move from domestic demand to global demand and start looking at, well, what's the rest of the world doing, right? ECB has 3 more meetings. I put 3x. That doesn't mean they're going to raise rates at the next 3 meetings, but there's 3 more meetings this year for the ECB, 4 more for the Bank of England, 3 more for the Bank of Canada. They're going to go again. The last CPI reading came in at a 40-year high. That was just this past week. PPI came in at over 14%. Greater than 14% on Canadian PPI, CPI over 8%, 40-year high. Tiff Macklem is a bigger hawk than anybody else in the Fed. He already won 100 without blinking. Is he going to do another 100? If this does not improve, yes, he will. Yes, he will. Because Bank of Canada has one mandate, price stability. That's their only job, price stability. That's their only job. So yeah, he's going to go. Bank of Japan 3 more times. Don't expect them to do anything. Their inflation rate is slightly over 2% right now. Just slightly over 2% because they have a very old population that don't consume that much anymore. 3%, sort of a little over 2%. I don't see them going anywhere. And Australia 5 more times. Yeah, I see them moving as well. But I think the most aggressive of all of these will probably be the Bank of Canada in terms of moving at each meeting and in terms of the size of the rate moves that we'll get, followed by the Fed, and I think the ECB is going to continue on as well. Okay, let's look at the most interest rate sensitive sector out there, housing. This is the National Association of Home Builders, Wells Fargo, the housing market index. 55, sitting at 55. You can see 2021, last July, it was sitting at 80, down to 55 now. Held pretty constant last year, even went into the year looking pretty good. Even into March and April looked pretty good, and then just 69, 67, down to 55. That is a big drop from June to July. Single-family sales next 6 months. This is the present. And traffic of prospective buyers. This is a diffusion index. So anything less than 50 is contraction, and that is in contraction. It's just the traffic flow coming through, 37. Single-family sales present, 64. That means that at this moment, there is still very strong demand. It's still in expansion. When we look at single-family sales for the next 6 months at 50, that is neither contraction nor expansion. It's kind of market. So we are seeing that traffic is slowing down. Sales are still going on, and we're going to look at DR Horton in a little bit. I listened in on their conference call, made some notes. So I'll present that to you. But the housing market index is dropping, but still in contraction. So what's the Fed going to do about that? Nothing. And I'll show you why down here. This is from the National Association of Realtors. Existing home sales for June. Existing home sales means completed transactions. This is for June, which means you could have had an offer accepted in April that closed in June, and it is recorded as a June sale. Look at some of these highlights from the report. 88% of homes that were sold in June sold in less than 30 days. The average was 14 days versus 16 days for May. It actually sped up. And this is versus 17 if you go back year over year. So 14 this July versus 17 days last July versus 16 days in May. It actually was faster. 88% of the homes sold less than 30 days. First-time buyers in June made up 30% of all sales. 25% were all cash transactions. 16% of homes were sold as second homes, which are counted as investor homes. Second homes or more are counted as investor homes. Less than 1% of all the home sales were distressed sales. That's a very, very tight market. That's a market that's not in any trouble whatsoever. Existing home sales declined for the 5th straight month. A seasonally adjusted annual rate of 5.12 million. Sales were down 5.4% from May and 14.2% from 1 year ago. You look at this and you say, aha, that is what we want to see. Till you get to bullet point 2. Median existing home sales price climbed 13.4% from 1 year ago to $416,000, a new record high. Buyers are disappearing. Mortgage rates are going up. Sentiment or the housing market index is dropping. I shouldn't say sentiment, it's dropping. But you have a new record high. Yes, sales are down. Sales are down month over month, year over year. By the way, this is 124 months straight of year over year gains in pricing. 124 months. A record for the price series that they track. Never have they seen this before, and this is a brand new record in terms of pricing as well. Do you think the Fed thinks, oh, it's time to stop? It's time to stop. Look at this, is cratering. No way. No way. The inventory of unsold existing homes rose, that's what we want to see, right, to 1.26 million by the end of June, or the equivalent of 3 months at the current monthly sales pace. 3 months inventory. That's it. This is 9.6% month over month and 2.4% year over year. And it may sound like a lot, 1.26. It's 3 months of supply at the current rate, and the current rate of home sales is slow. If there are homes out there, they're selling. As we can see, they're selling fast. And this tells me that there is no problem in the housing market that the Fed needs to take care of right now. The wealth effect for people is still in place. Sure, some housing prices in some markets have contracted from the frothy high, but when you see this going on, I don't know. I don't know that the Fed is going to pivot. I don't think this is going to disappear by September, where they feel that they can drop to 50 and then guide for 25 for the next 2 meetings. I think the market's completely wrong on this one. Last week, July 19th, we also got building permits, housing starts, and housing completions for June. Building permits are down 0.6% month over month, but up 1.4% year over year. It's not that exciting. Housing starts down 2% month over month, down 6.3% year over year, but housing completions were up 4.6% year over year, down 4.6 month over month. Overall, I don't see that any of this is going to do anything to move the level of inventory, which will do nothing to move a housing price index, which is going to do nothing to move the shelter component in CPI. There is still upward price pressure on the market, and being that the housing price index isn't peaking yet, OER and shelter is not peaking because, again, you got that lag, right? It's going to continue to grow. Mortgage applications, July 15th, the lowest level for the mortgage market, the activity in the mortgage market. Lowest level since 2000, 22-year low, down 6.3%. Refis down 4.3%, down 80% year over year. And purchase index down 7.27%, down 19% year over year. This is all seasonally adjusted data. If you don't seasonally adjust it, you get to 17% increase week over week. So you can see some seasonality in there. If we're looking at the effect on mortgage originators, how did they do over the course of the week? What was their market like? This is what we would use. Well, it was up 17% week over week. There was more business that week than there was the previous week because companies don't report revenue as seasonally adjusted. They report revenues. We look at economic data as seasonally adjusted because we want to get to a trend. But for company revenues, we are more interested in the non-seasonally adjusted because that is what's going to show up in revenues. So let's say that we have a data series that looks like this. What we want to do is we want to get rid of this. We can see this could be Q4. We see some real seasonality here. So we will use a regression and we'll use a seasonal component in there to try to capture the trend that's going on. Because it is the trend that tells us the direction that the economy is going. But if we're looking at these peaks, it makes it hard if we're just looking at unseasonally adjusted data to determine, well, are we growing? Are we going sideways? Because I see that month over month, so this is this month, this would be the month before, month over month, that was an incredible gain. We're doing really well. However, when you seasonally adjust it, you could see that month over month, no, not so much. It looks like the growth is still happening, but growth is happening at a slower rate, so we're slowing down. You want to take that seasonality out of it for better comparison. If you're comparing year over year, like let's say you're comparing Q4 of this year over Q4 of last year, you can use both seasonally adjusted and non-seasonally adjusted data because you're looking at the same thing. It's just if you're doing it month over month and one month has a seasonality component in it where the other one doesn't, well, you're not going to get a very good comparison. You want to try to get to that trend line in there and compare it on the trend. So I sat in on DHI's conference call this week. Strong EPS, 467, 50 some percent increase year over year. And they were reporting their Q3 2022 earnings. So they're in Q3, even though we're in Q2 for 2022, they're in their report was for Q3. So some items that I picked up on that I thought would be interesting. They are reporting a moderation in demand that they saw in the final month. However, even though there's a moderation, they still said there's still strong demand. It's just that strong demand is moderating to somewhat strong demand. First-time buyers made up 56% of their sales. They are seeing an increase in cancellations, 24% cancellations versus 17% in the same period year over year, which lowered their sales 7%. The sales would have been 7% higher. Supply remains limited. That's all you have to know where the housing price index is going to go. The pace of price increases will begin to slow in Q4. They didn't say that price is going to decrease. They said the pace of price increases will slow. So rather than increasing 15% year over year, it might only increase 10% year over year. Then maybe the quarter after might be 6% year after year. The pace of price increases to slow, but still price increases. They are seeing construction delays. That's not going to do much to increase supply. So pricing will remain strong for a while. They have, I think they had reported record margins, over 30% gross margins on their bills for the quarter. They did reduce their delivery guidance for 2022 and the number of units they can deliver because of the construction delays. Here's a long-term chart going back to 2000, beginning 2007, sometime in 2007 for DHI. They went sideways for quite some time in here. You had a certain amount of underinvestment. This is all the way 2011, 2012. The housing market in the U.S. was, well, it was in the doldrums. Nobody was doing well, but nobody was investing and nobody was building. And then they started to, their fortunes started to improve, as did the whole sector. But during this whole period of time, as we've seen on charts many times in this series, inventory shortage. This was the pandemic. I think you can, sort of just, I say these big drops, you can sort of just forget about this. This is the overreaction on the upside. I think you can forget about that as well. Here is sort of a bottom part of the growth channel, the top part of the growth channel. This drop over here from $53 to $33, this was the last Fed rate hike cycle. So they dropped in price by 38%. But because this was a sector of underinvestment for so long, where demand is going to exceed supply for years to come, they recovered quite nicely and even went on to form new highs before the pandemic happened. Look at their inventory, their dividend record here. 3.75 cents, increased to 6.25, increased to 8, increased to 10. Every year they increased to 12.5 to 15 to 17.5 to 20 to 22.5. Now, yeah, they're increasing every year, but that's still only a 1.16% dividend yield. Their share buybacks, roughly about 3%, that they are forecasting for the end of their 2022 year versus the 2021 share count, that the share count will be 3% lower. Q4 guidance, 10 billion to 10.8 billion in revenue, 23.5 to 25.5 closings, which would be up from Q3, and gross margins of 29 to 29.8%, which is 150 basis points lower than what they had for Q3. Since they've reduced the amount of new builds also that they're starting, and most builders aren't building on spec anymore. All this is going to do, this interest rate hiking cycle, is it's going to reduce the amount of inventory that is coming to the market, with prices still continuing to increase. Family formation year over year is still outstripping the amount of new homes that are coming onto the market. Inventory is going to remain tight for a while, at least another 20 years. I think it's going to remain tight 20 years because the baby boomers are just retiring now. We're halfway through that retirement. We're the first 10 years through the retirement of the baby boomers. Figuring an average life expectancy of 85 years, we're halfway through it now. In another 20 years, we'd be halfway through the 85 age cohort. And from 2030 onwards, supply will be hitting the market as they pass on. Peaking in 2040. There, I think from 2040 onwards, you're going to solve your inventory problem just from attrition, unless immigration really picks up. But I think you have lots of room left to run. What was also interesting on their call was they're really growing the rental division. They are anticipating 800 million in rental revenue, which when you have rental revenue, that lowers the volatility of your revenue because you always have that recurring revenue stream going on. So I like that idea. So I'm looking at a short straddle on this one, a 90-60 short straddle, pace 457. The break-even points I've denoted with just blue lines here and here. I don't think this is a reality anytime before November. Anything above $95 I don't see happening, so I'm good with the 90 strike with a 457 premium. Puts it almost at a 95 break even. Supported here at 60 when the they hit this low point when the 10-year peaked at 3.6 something percent. We're under 2.8% on the 10-year now. Mortgages are tied to the 10-year treasury. So the premium brings it down to a little over 55. I think this inventory shortage continues. So I think if you take your trend line in here and you draw your trend line up, I think that trend line continues. Now I just sat in on this call. This is not saying that any of the other home builders might not be a better buy. It's just on this one here, I look at this and I say, there's always a trade. Especially if you start bringing options into it, there's always a trade. If you don't have options, then it's a straight up and down buy or sell. In which case I'd say, I don't know if I'm a buyer at 77.10. I'm a buyer somewhat lower, but I'm not a buyer at 77.10. So if it was a straight up buy and sell, then I'm on hold. But with options, there's always something I can do. Sure, I'd like it to, if it got under 60, maybe I would pick it up. So how do I get there? Well, I'll use this straddle because I just don't see this part of the distribution, and I don't mind anything below that distribution. If it doesn't get below 60, I don't have to buy it. If it doesn't get above 90, well, I don't end up with a short position, and then I can do it again. I get to wait till November, and I can see, well, what are the conditions now? Would I change my strike prices? Would I do a straddle? Would I just buy it now at this point? Would I use an in-the-money put to make sure that I buy it and buy it at a lower price? I can reevaluate how I feel at that time. The other reason I prefer doing this and why I would probably, if I were going to do DHI, do it in some sort of synthetic or with in-the-money puts. Like if I really, thought that 2023 was going to be a good year, I might sell December 2023 $100 puts. The reason is this dividend, being that I'm in Canada, I don't get that dividend. There is a withholding tax, so it's actually lower for me. However, the dividend is, the present value of all those dividends is in the option premium. So by using a synthetic, for example, I smuggled the entire dividend into Canada in the form of a capital gain, which is taxed at a lower rate than the dividends, and I don't have any withholdings, and I avoid a whole lot of currency exposure at the same time. But if you were interested in DHI, there's some good opportunity in the premiums. You have implied volatility sitting at 47%. Way back here, it was low 30s. Let's look at some PMIs. And I will give you a link to a site where I got these from, where you can get the PMI reports from everywhere in the world in whatever language that you like. Here is US PMI, and here is Eurozone PMI. The PMI composite 47.5, 26-month low. 26-month low because it's looking at the pandemic. Ignore the pandemic. Look where you have to get to. To get to this sort of trend, you have to go back to the Great Recession on the PMIs. And I think that's what some people who are looking at the Fed pivot are looking at, saying PMIs are rolling over, housing activity is rolling over, which it is. Housing activity is slowing, PMI is slowing, manufacturing services, there are signs of slowing here. But I don't think that the Fed is going to take that and say, okay, well, off we go. Let's pivot. 47.5, services 47. Anything under 50 is contraction, which means the composite output index is in contraction. Services are in contraction. Manufacturing output, not so much. The manufacturing PMI is still showing expansion, 52.3. If we look over at the Eurozone, 49.4, there's contraction. PMI services 50.6, still expansion. Output 46.1, that is contraction. And manufacturing 49.6, that is contraction as well. But this is going to include all the countries that may be affected by what's going on in Ukraine. So you do have available on the site that I'll show you, country by country, that you can go into, because some countries are more important for Eurozone GDP than others. So this data shows you when it was collected. This is the 6th, July 21st. This is July 6th to the 21st, July 12th to the 20th. I'll get it. Okay, so here's the PMI releases by S&P Global and releases for July, and you could just read down. There's a whole bunch of different data that they get, business outlook reports, everything. So let's just go up here. This is US composite PMI. Just click on view more, a new window opens up and you get the full report. The key findings gives you a historical graph that you can look at it visually. And then goes into some detail about it if you're interested in reading a little bit more. It doesn't go on for very long. They're short reads. So if we go back here, you can see you have the UK. Here's the Eurozone. And you just scroll down to you find what you want. Here's Germany. You can get it in German or you can get it in English. There's France. You can get it in French. Japan, you can have it in Japanese or in English. There's Australia. Business outlook for India, Europe, Brazil. What else have we got? China business outlook, France business outlook, Germany. Lots of good stuff that you can look at on this page. All right, this week in earnings, July 22nd. First bullet point here, 2022 Q2 year-over-year earnings expected to be up 6.2%. Excluding the energy sector, the estimate is to be down 3.2%. That is the expectation. We'll have to wait until everybody reports to see what it is. Of the 106 companies that have reported to date, 75.5 have reported earnings above analyst estimates. So the estimates for earnings is 6.2% year over year, and so far 75.5 have beat those estimates. Revenue is expected to be 11.3%, excluding the energy sector. Growth is estimated 6.7%. 68.9% have reported revenue above analyst expectations. Last week we were at this little point here. This is the earnings revisions. Look where we are now after last week's slew of earnings report. We are now higher. If we look at the earnings versus expectations, this is of the companies that have reported so far. The surprise factor, 4.7% above expectations. We are expecting growth in earnings of 6.2%. That's with the energy sector, and we are 4.7% above that. That's, you don't add those two. If we were expecting 6.2% to be where expectations were, we're 4.7% above those expectations. So 4.7% above the 6.2%. So multiply, don't add. That's out of 100 companies reporting so far. Let's see where revenues are. Revenues are coming in 1.3% higher than expectations. So far of the 106, 20% reporting. We are higher than the expectations of 6.2% revenue growth and 6.2% earnings, 11.3% revenue. Let's go down to our forward forecast here. Forward 4 quarters, still 239.37. Now I know that I've listened to quite a few companies that have reported that have lowered their guidance. Some have raised their guidance, some have guided in line, but there were quite a few that have lowered their guidance. This number has not budged, 239.37. I'm growing suspicious of that number. I think it might be a little lower than that. I'm not saying 20% lower, but for it not to be down by 50 cents or 60 cents based on what I've seen last week, I find that a little, to be exactly the same, to not have changed. Maybe it's just that the analysts that they aggregate to get these numbers have not updated their numbers yet, which is odd usually, because every company that I've followed, after they report earnings overnight and into the next day, you get all of the analyst updates. So I don't know. This seems a little odd. Here are growth rates. S&P 500 year-over-year growth rates. We're in the second quarter right now. Revenue 11.3, earnings 6.2, and we're seeing that so far of the 20% that come in, it's beating the expectation, and this was the expectation. This is where it starts to get a little curious for me here. You got still 11% for 22 Q3, 10% year-over-year on earnings for Q3. When we're seeing the PMIs that are going into contraction, that were not in contraction in Q1 and Q2, but are in contraction. This is July. We're seeing the numbers being reported now. The PMIs were for the first part of July, going into contraction. Yet this is not showing any change in these. Q4 8.2% year over year, 9.7% in earnings year over year. I just find that a little odd that there isn't some give on this. By not giving on this number, you risk the credibility of that number. Even if you would have lowered it 60, 70 cents, at least I would have said, well, okay, I see that it's coming down as it should. But by keeping it firm, there's some credibility, I think, that is being lost there. Who's reporting on the week coming up? There's a whole bunch reporting. I'm not going to read them all. You have Google that is reporting on Monday. On Tuesday, who are your big ones? Archer Daniels, Midland, General Electric, General Motors, and that's in the morning. I'll live and die by that one. We'll see what happens there. I've hedged out quite a bit with options, but I'm not expecting a huge rally in General Motors on this one. Coca-Cola, McDonald's, Moody's, quite a bit here. Pulte, UPS, 3M. This is a big day here. Boston Properties. There's a couple other equity residential, Essex Property Trust that are in there as well. Microsoft, Juniper, Teradyne, Texas Instrument, Visa. This is a big day. Tuesday's a big day. Wednesday, you got a lot on Wednesday as well. I'm not going to read them all because I'm sure that you can read them. Meta platforms. There's Facebook on Tuesday. With the slowdown in advertising revenue, let's see how Facebook does there. And there's your Thursday, and there's Friday. I think it's over 168, I think. Let's see if we can find out how many are reporting this week. It should say right at the very beginning. 172 are expected to report quarterly earnings. Now, listen to me here. You're going into a big bad week. I don't think there's been will be a worse week, not a worse week, but a badder week in terms of what's going on. You got 172 S&P components reporting earnings. On Wednesday, you have a Fed meeting. On Thursday, you have your first look at Q2 US GDP, and on Friday, you get the PCE. Don't be a hero this week. Don't be a hero. There's way too much going on this week. Way too many unknowns. I think that earnings will be what earnings will be for a couple of days. I don't know that, other than moving the company itself, I don't know that they're going to be major market moving things unless they're really bad, because you got the Fed on Wednesday, and I don't think anybody's really going to take on new position risk ahead of that. Speaking of that, let's go have a look at what the week ahead holds for us. Okay, our macro risk calendar. On the previous screen, we saw our company-specific risk calendar, and company-specific risk can aggregate and create a macro risk variable if guidance is generally weak for the reporting companies, 172 of them. If they aggregate to weak guidance, that will create a macro risk variable for the market. But for the most part, earnings are company specific. They can be economic specific if we start to see a certain theme, or if one company is big enough that it can actually move a market. What do we got for economic risk? On Tuesday, the U.S. Housing Price Index, month over month and year over year, and also the Case-Shiller Home Price Index as well. They just measure different cities. Different geographic regions. But I don't expect them to show significant rollover. I do expect them to still show a double-digit growth year over year. Let's keep going into the next day. Wednesday starts with durable goods at 8:30. I don't think that's going to be that important as well. It'll be mentioned. There might be a little bit of jiggling around on the futures, but it's all about this one here. The Fed interest rate decision at 2 o'clock, followed by the press conference. And I find that there is more volatility during the press conference than there is on the interest rate decision. This happens, and then it sort of goes away within a minute or two, and then we're sort of in a holding pattern until the press conference starts. Followed the very next morning at 8:30 with Q2 GDP, our first look at US Q2 GDP. Q1 final revised number came in at negative 1.6. The forecast here is for 0.4%. This is real. It's not nominal. It's real. It's deflated. And if you're looking for the price deflators, they'll be reported, the core price index quarter over quarter. You have the core PCE. So you'll get the deflator as well. And there are your PCE prices quarter over quarter. This is the one you would use to deflate the entire series with. So if you add them together, you'll get nominal. And nominal is what companies report, because companies make nominal revenues, not real revenues. They report nominal EPS, and their share price is nominal. So if we're interested in the size of the lake that companies fish in, we would look at nominal GDP. If we're looking at the number of fish in the lake, then you want to look at real GDP. Very next day, core PCE. This the Fed meeting is passed. Maybe somehow they get this number. I don't know. Maybe it's shared privately with the Fed, saying, okay, well, this is Friday, you're meeting Wednesday. It's probably important for you to look at. I don't know if that actually happens. I honestly don't know. It would seem odd that somebody like the head of the Fed couldn't get a sneak peek at the number by calling the president saying, come on, man, you know, we're making some big decisions over here. Can we get a peek at the number? I don't know. Maybe they can't. Maybe they can. I don't know. But if they do have it, it's certainly not going to show up in the minutes. We're not going to know that they had it. But anyways, it happens for Friday. For the rest of the market, this will give us an idea of what September may look like. The core price index year over year was 4.7 previously. The forecast is for 4.7 as well. You come in at 4.8 or 4.9, that's going to get ugly. If you come in with a significant drop, which I'm just not seeing much of a significant drop as a probability here, but it is the PCE, not the CPI, so you could. And then you have all of your components, your personal income, your personal spending in here. Then Michigan consumer sentiment at 10, some big numbers to look at. In the GDP report, I think we should also get the employment cost index to see how wages have been rising. But we get that information. We can get that information almost on a weekly basis with the Atlanta growth wage tracker. You can get it on a monthly basis. There's lots of sources to get that. I don't know that there's going to be too much excitement or too much meaning in that number. So there we go. 172 company-specific risk events next week, a Fed meeting, first look at GDP, and PCE, which will start to give us some idea of what the Fed will do in September. Huge macro and micro risk going into next week. So, have fun. Okay, before you go, let me give you an update to the Applied series, the fall 2022 editions to this series, because I'm 3 weeks away from beginning to add some new content. Mid-August to beginning of October, I'll be adding 6 case studies, and the case studies pertain to sectors of the S&P: consumer discretionary materials, real estate, financials, consumer staples, and information technology. And how they'll be structured is the first part of the case study is going to give you the economic backdrop, what's going on in the economy right now. The second part will describe the sector itself, consumer discretionary, let's say. Well, what is the type of environment in which consumer discretionary does well? What kind of indicators do we need to see? What kind of economy do we need to have? Then we'll identify an ETF and its components. And whenever we have a particular stock or stocks and we have options, there is always a trade, always. There's never no trade. There's always some trade, because there's always some part of the distribution that you either disagree with or you agree with. So there's always something to sell and always something to buy. Your job after going through the case study is to determine what the trade would be. How would I trade this particular thing if that's all I had to trade at that time? The second part of the case study would be a discussion of the possible trades that you could consider given where we are in the economy, given the sector that we happen to be in, given the outlook for the economy and the outlook for the sector. How would you position yourself and how would you trade? And we'll go through 6 of them. So by the time you're done the case studies, you should have a very good understanding of what makes for a good investment in each of these sectors: consumer discretionary, materials, real estate, etc. A good idea of the major ETFs within those sectors, and for those who want to dive a little bit deeper, the components to the ETF. Because sometimes a good trade involves selling calls on the ETF in general, but buying calls on the underlying components. So we may sell the call on the ETF to finance the purchase of the call of one of the components that you expect to outperform and do just a relative value trade. There's always a trade to be done. From October, about mid-October to mid-January, I'll be adding the macro top-down course. And in a nutshell, it looks like this. It looks simple, right? But basically what this is saying is that the price of anything is a function of 2 things, a numerator and a denominator. Your numerator is your cash flows, your denominator is your discount rate. And there are macro influencers that will influence the series of cash flows, or that will influence the level of the discount rate. That's really as far as top-down goes. You analyze what's going on all the way down to how you think it's going to impact a numerator and a denominator. From there, you can then go into a bottom-up analysis to determine which companies would benefit the most from either an improving numerator or an improving denominator. But this will be a fairly detailed course as well. The current price of the course right now is $275. This is a 3-year subscription, by the way. Well, I say 3 years. From the time I launched it, it was a 3-year subscription. We're 2.5 years left now. It goes all the way to December 31st, 2024. So you have access to it all the way to the end of 2024, which is another 2.5 years from now. And there are more sections that are being added. Right now, the cost is $275 Canadian. So if you're in at $275, then you're good. You get all the updates and everything up until 2024. As I add more content, the price does increase for newer buyers. But if you had bought it at $275, you never get a price increase. This $275 is equivalent to $220 US. And the reason I'm putting the US price in here now is, as most of you are aware, I had sold my business earlier in the year to Serify, which is a US-based company, and we're still in the transition of moving into their company. And the last thing that needs to be done is the price change from the Canadian price to the US price. And they're going to, at some point in the near future, you're going to notice that all our prices switch to US pricing, but with whatever the exchange rate happens to be. So it's not going to be more money. It'll be the same money, except we're going to save much of the world the conversion into US. And for our Canadian subscribers, we get to avoid that 13% of that sales tax. Some provinces high as 20% on the sales tax. So that's not so bad. So the 275 equivalent is 220 US. The price, once I get halfway through, once I've added the first 3 case studies, it may not be this order. I've got them listed like this, but it may not be, 1, 2, and 3. It may be, 1, 2, and 3. But after I add the first 3, the price will increase to $395 for any new subscribers, which is $316 US. So if you feel that you want to add this subscription, you can lock it in at $275 Canadian now. Before it does increase to $395. I figure I'd be halfway through sometime around mid-September. Mid-September I should be halfway through, and then the price would increase. And then after I'm done the macro, the price will be stable at $395. This covers all of this. Until I start adding the next sections, then that price would increase as well. But there we are for the fall. You're going to get 6 case studies. You're going to learn a lot about these 6 sectors of the economy, and then we're going to go into a macro top-down approach. Reason I wanted to start with top-down instead of bottom-up, there was a lot of requests of, we really should be starting with bottom-up first. I don't think that's true. Asset allocation in terms of being in the right sector is far more important than being in the right stock. So if I can at least get you in the right sector, you don't have to worry about being in the right stock. It is far more important from a return perspective to be in the right sector at the right time. So I think top-down is more important to do. Bottom-up stock picking is hard, and it's a lot of work. So once we know what sector we want to be in, once we've identified an ETF, we've automatically identified a whole bunch of components of which we can then do a bottom-up analysis on. There we go.